So here is my trading 212 invest account, and as you can see, the portfolio balance is currently £18,361. Here is my trading 212 ISA account, and you can see the portfolio balance is £45,321. Here is another stockbroker that I have, and as you can see, the current balance is £63,062. Here is my free trade account, and as you can see, I have around £2,300 here. Here's another stockbroker with £666 looking really devilish. So my question is, at the age of 30, have I invested enough to have a decent retirement when it comes to that age? So in this video, I'm going to actually explore what it would take for me to actually stop any further investments into any of my stockbrokers and see if it's feasible to be able to retire without investing a single more penny at the age of 30. If you would like to sign up to Trading 212, my preferred platform for investing, and receive a free fractional share worth up to £100, then all you have to do is click the link in the description and sign up. Alternatively, what you can do after downloading the app is to go into the 3 horizontal line menu here, scroll all the way down and go to use promo code. And in this menu, you can apply the code JUBAIR and you should receive a free share. So combined in the portfolios that I've showed you, I should have around £120,000 invested into the stock market. Whether it is up or down, this is exactly how much I would have if I'd sold all my holdings at the age of 30. Now recently, having gotten married, I've realized that things really do change, and it's nearly impossible to predict all the future costs that you're going to make because things change so rapidly. After you get married, you have children, all these sort of costs. When I wasn't married, I could afford to put away £1,000 to £2,000 per month, and my goal was to retire really early with that huge amount of deposits that I can put in, let's say £2,000 per month, to retire by the age of 40. Now realistically, things do change, and it's up to you to be dynamic with your retirement. You can't just set it and forget it and expect everything to work out for you, because it's really hard to predict what's actually going to happen in the future. The idea of retirement is so alluring because you no longer have to work to pay your bills and a few other shopping items, and you can relax and spend more time with your loved ones. Now if we use a compound interest calculator like this and put in our initial investment of £120,000, let's say we can achieve an interest rate of 10% per year, which is actually kind of ambitious if you think about it, but in the stock market so far, I've received at least 10% per year. So we're going to put in 10% and see what happens. Now I am currently age 30, and in 30 years I will be 60, and realistically I would like to retire way before then, but the stock market has a lot of fluctuations in the short term, so I can't really recommend anything less than 20 years. So let's put in 30 years just to see if we can afford to stop putting extra deposits. So there we go, 30 years put in. So the deposit amount, we're going to do £0 monthly, and of course we're not going to increase these deposits. So let's calculate that. So based on this projection of getting 10% on my money per year and not giving any extra withdrawals, I could expect somewhere in the region of having an investment value of £2,380,000, which is absolutely crazy. 2.26 million in interest earned alone in those 30 years, getting 10% every single year. You can see that my initial balance remains at £120,000, meaning that I don't have to deposit a single penny extra. As long as I get 10% in the market per year, I should be fine for retirement. The 4% rule states that, you can take out 4% from your portfolio and you should still grow as a function of time. So let's say you can get 8% per year. Obviously, it doesn't work every single year, but if you take out 4%, it will still grow by 4%. Now, 4% of 1 million is £40,000. And with this portfolio, I will be looking at over £90,000 to spend in my retirement. Bear in mind that if this was in an ISA, which I could easily transfer into because I already have this money, all of this would be tax-free. Now, of course, assuming 10% in the market every single year is kind of a very big presumption, and you might not get 10% every year. In the same vein that you might not get 10%, but you might get 30% a year. Who knows where the future of the stock market is going to go? And in the opposite vein, you can end up getting 1, 2, 3% or even negative percentages. But of course, as we know, stock market investors, we put our money into the stock market with a higher risk, with the potential of actually achieving higher rewards. At 10% interest per year, our investment doubles every 7 years. So let's go back to this example and see if I could retire at the age of 50 without depositing another penny. So in 20 years, I'm going to be 50, which sounds crazy when I say it. And of course, deposit amount, we're going to leave at £0. And then let's press calculate on that. So those last 10 years actually make a huge difference, almost £2 million of difference. And you can see in 20 years with the same amount initial deposited of £120,000, I'm looking at a portfolio value of only £879,000, which would give me a tax-free income if this was in an ISA of around £35,000, which unadjusted for inflation in current today's money should be enough to not worry about bills and also not worry about working at the age of 50. Doesn't sound too bad at all. Now, if I still wanted to achieve that slightly early retirement at 50, what do I really have to contribute to get a portfolio value of around 1 million, which will give me around £40,000 in tax-free retirement when I put this in an ISA. Currently at this point in time, I'm earning more than I've ever earned in my life, but I'm actually saving less than I used to when I was making less. This just goes to show the power of actually trying to forecast the future to see what kind of costs you're going to have, emergency costs, costs of moving home, costs of your children graduating, weddings and things like that do have to come into the equation. Now, if I could save £100 a month, which I don't think will be too difficult to do actually, let's see what will happen in 20 years with the same deposit amount of £120,000. Now you can see just by depositing £100 per month, that projection in 20 years goes up to £955,000, which will give me a near enough £40,000 to retire off of. Now, of course, I can change some of the variables and maybe 10% is too high and maybe 20 years is too low. But if you really think about it, the main thing that I can change is how much I can deposit per month. And this can impact things quite a lot. Now at £200, which is double what I was planning on putting before, we can achieve early retirement at 50 years old with an investment value of £1,031,242, which should give us a tax-free amount of around £40,000 per year, providing that the market gives around 6+% on average per year. Now, if I absolutely wanted to retire in just 10 years, I could reduce the amount of years I want to stay in the stock market to just 10 years. Let's see if I could deposit £1,000 per month, which is of course a lot higher than £100 per month, and see where that would get us in 10 years. Now, as you can see, in 10 years, I could have a portfolio balance of £529,000, which doesn't quite get us to that nice £40,000 per year tax-free retirement spending. However, we've seen the differences that time makes in the whole compound interest journey. We can even look at the graph here and see that it is more linear than what we see with longer years in the stock market. For example, if I change this scenario to 40 years, you can see that the graph now takes on this shape, the parabolic shape, a curve shape that actually shows that this is an exponential increase. And this is basically the power of compound interest. And if I was really lucky and I could put in £1,000 per month for 40 years, I could have an investment portfolio of £12,768,000, which I would be really happy about. But realistically, £1,000 per month for that long is going to be quite a stretch, especially with having a family. So you might be wondering, let's be a bit more realistic and see a lower percentage. Let's go with 6%, which isn't ambitious at all in the stock market. Now we're going to have to stay with 40 years, and in 40 years I'll be 70. So maybe let's just switch this to 30 years here. Now let's deposit £1,000 per month and see what happens. So in 30 years, depositing £1,000 per month and getting only 6% in the stock market per year, we could still have a very comfortable retirement portfolio of £1.7 million. Let's see the effect of a negative 10 years on that investment. You can see that even with a 6% return, putting in £1,000 per month, I could expect £850,000 in about 20 years. Now, the initial question was, can I stop actually depositing into the stock market and still retire in a reasonable amount of time? So let's switch this to 6% yearly, stay in the stock market for 20 years, and this is a projection of only £397,000. So the main factor here is actually the returns that you get on the stock market. If you can achieve 10% per year, then retirement seems more feasible. But if you were achieving 6% in the stock market every single year, then I think you might want to look into different funds, or you are probably being charged too much by your fund provider. So make sure to check out some of my other videos, and I'll see you in the next video.